Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
Gene Trowbridge and Jonathan Ney, founding partners of the top syndication firm, Trowbridge Law Group, LLP, have a legal team with over 50 years of combined experience in real estate syndication and the practice of real estate securities law. Over this time, Gene and his partners in several past firms and currently have helped clients raise close to $5 billion in offerings by empowering entrepreneurs to raise capital legally. To learn more about Trowbridge Law Group, LLP, visit their website at trowbridgelawgroup.com or follow them on Facebook, Instagram, or Twitter. This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Kam Zainabadi. Thanks for being on the show, Kam.
Thank you for having me, Whitney.
Dr. Zainabadi is both a medical doctor and a seasoned real estate investor. He has teamed up with Silicon Valley to remove any barrier for syndicators to enter online real estate crowdfunding. These barriers imposed by current platforms include high cost, stringent assets under management criteria, exclusivity agreements, and many more. Kam, thank you again for your time. This is an interesting topic, especially for syndicators, and I feel like we should all know more about crowdfunding probably and what that is and why that relates to our business. And so let's jump right in and tell us a little more about your background, your business in real estate, and your crowdfunding piece here that you're building.
Absolutely. I mean, my background, I've as you said, I'm a medical doctor, but I've known all my life that real estate is the way to build the best way to assets. So right after residency, when I started, it was actually during the financial crisis, and I started building my real estate portfolio through purchase of many single family homes in the area, in the markets around where I was working. And then I expanded that into multifamily portfolio. Then I went through my kind of connections I made in this real estate business, I started investing as passive investor in syndications. Then I jumped into in 2012, and afterwards when crowdfunding and became a viable entity through the Jobs Act, and there was these crowdfunding sites starting to kind of take root and take hold of that segment of the crowdfunding market, and for real estate, I started investing with them. So that's really my personal background. I've also, besides real estate, I've also invested in angel. I've been an angel investor. I've made connections in the Silicon Valley, and that's where really my strengths are. That I had connections and relationship between both the real estate market and a good knowledge of it, and also from the VC side or angel side, I kind of really got to know the workings of Silicon Valley and how a startup could succeed.
Nice. So it's interesting, just your history in investing. I mean, single family to multifamily, then you went passive in syndications, and then also, then got into crowdfunding as well, and other types of investing also.
Sure.
Why don't talk a little bit to us about, what you're currently working on in the crowdfunding space, and let's jump into, what crowdfunding is.
Sure, absolutely. Sure. I mean, crowdfunding it started in 2012 with the Jobs Act, and it allows, let's go back a little bit. In order to sell any kind of security, usually SEC frowned upon general solicitation. That meant that
right.
You could only, whether it's stocks or real estate, you can't really go and advertise it, for example, in the Wall Street Journal or nowadays online on the internet or social media. That was really frowned upon until around 2012, and later on when we had this crowdfunding exemptions and the 506c exemption and things like that, and that allowed actually the kind of the burgeoning or the rise of this whole sector of the market, which is actually one of the largest growth sectors, about 50% year over year. So it's going to get larger and larger in the future, and that's no doubt about it. So crowdfunding allows, for example, let's talk about real estate because that's what we're here for. Allows real estate professionals such as syndicators to take advantage of that, because as you know, syndicates really kind of were limited to the pool of investors they knew. I mean, they usually have a core of investors, and they always are trying to get more investors to invest with them. And this is, I mean, there's there's wide part of the spectrum. There's really high, the really successful syndicates that have large amount of asset under management, and there's a large sector of the market that's just trying to build a network of investors. So what does that mean? They could, be able to acquire larger asset classes. You're kind of limited by really money, right? I mean, that's always the issue. So this allows really those syndicates that are trying to build up their pool of investors to jump into the arena and be able to, be more successful. And that's the way to do it typically is through 506C. That's most of what the real estate syndicates have done, because Reg A, which is one of the other two ways of doing crowdfunding, is very difficult and strenuous and it's very difficult to do it. And most syndicates don't really do that. It's really kind of a pre-IPO, and it's just time and money consuming, so it doesn't really work. CF, or crowdfunding exemption, actually the limitation is really allows only $1.07 million, but that actually has changed. So the big limitation with crowdfunding exemption was you could only get it in, you could only raise about $1 million, which, it's most of the time it doesn't really work for any kind of syndicated deals. However, there's been a new ruling, which is going to go into effect in the next few months. It's going to raise the limit to $5 million. So that's a big deal for crowdfunding exemption. That allows more of these real estate syndicated deals to be able to actually use the crowdfunding exemption. So those are the three different exemptions we talked about. Where Park Place comes in is, in my investment with the crowdfunding platforms, which I'm not going to name, I found that it is, there's certain limitations and there's certain strengths to them. They highly vet their deals. So that means kind of the funnel, the end of the funnel really allows only 0.2% of all the deals that they vet to go through. So it's a very difficult selection criteria for them. And number two is the cost they impose on syndications could be anywhere between 5 to 7%. So as you can imagine, if you want to raise $10 million, it could be quite a bit of money. So really their deals are kind of limited to the larger syndications that are really are okay with that. But that leaves a large amount of the startup syndications and mid-sized syndications out of the arena. So what some of these syndications have done, they've created these portals for themselves, either through white label software, and allow to build up the pool of investors. As you can imagine, it's very difficult to market yourself to the entire internet community, because their strength is not really in that. Their marketing was more towards the friends and family model. It's not really their segment of strength. So having said all that I realized, listen, this is just it's time to change that, really. And that's where Park Place came from. I spoke to a few of my associates from Silicon Valley, and they kind of did some due diligence for me. I said, yeah, this is actually a really good idea. I mean, you could, and the idea is create a platform that basically it's a marketplace where syndications could list their deal. It's very simple to list. They could list it within 10 to 15 minutes. And the listing goes live. And then from the investor side, the investors, if they search for a deal and if it meets their, for example, location, certain criteria, then they basically connect. And we are, that's what we're doing. We're facilitating those transactions and meeting up of the investors with the syndications. We are actually not doing we're not getting a cut of that. So that's the model that's different. We're trying to democratize the entire sector, and I think I believe there's many ways to, as far as the company's health financially, you could monetize it from a different way than the current crowdfunding platforms, and a way that would create a more of a win-win situation for both investors, both for syndications, and of course for us to be able to survive and financially and bring more of our services to the community.
Could you go a little more in depth on the relationship between, let's say, the syndicator operator and something, like Park Place Investments, and what that relationship looks like, when they have the deal, and what happens?
Sure, absolutely. So the relationship, as far as it's a quite, it's a partnership really, because the syndications have complete control of their deal. They and Park Place we want them to know that Park Place is another way, not the only way. So when they sign an agreement to list a deal with us, we don't have an exclusive agreement, because that's not our business. We want them to succeed any way they can. So it's really a partnership. They would list their deal, and the deal is going live. We do a vetting process ourselves, because make sure we don't have any bogus deals, but we really kind of rely on our relationships that we built even before the listing for the syndications, because we have so many syndications that we know, and we want them to create the partnership of going live, and that's for both of our benefits. Now, so when Park Place, when the syndication lists the deal on Park Place, the deal is live. They upload their photos, the entire deal information, and then second thing we provide, if they choose to use our services, we have services that provide anything with the if they want to do 506c, we provide all those services. If they want to do a prospectus or offering memorandum, which is a requirement, although not strict for 506c, we could provide those services. Obviously, forming a real estate entity, which if they choose to use our services, we could do that. And that's from the legal and kind of regulatory standpoint. So those are things we facilitate for them. And also, we've created a relationship with certain financial institutions that if they choose, if they want to use our lenders of choice, we could certainly provide that. So it's kind of it's a community. We provide these services. If they choose to use it, they would. If they don't, they don't. And lastly, we do not charge any percentage commission on the capital raise. That's not how our model works. So we want to make it really easy for them. We don't want them to list a deal and be charged $50,000. Really, I don't think that's really a way to form a partnership.
Bedford's Cost Segregation specializes in generating significant tax savings via their engineering-based studies for commercial real estate clients nationwide. Founded in 2002, Bedford is one of the largest independently owned cost segregation providers in the country, with over 14,000 studies completed to date in multiple offices throughout. The most important decision ownership can make when incorporating cost segregation within their real estate portfolio is selecting the right provider. With only 43 certified cost segregation professionals nationwide, Bedford is proud to employ 8 of them and takes the quality of their people as seriously as their studies. Every certified cost segregation professional has passed a rigorous test combining knowledge of technical engineering issues, legal tax issues, ethics standards, and requires a strict level of prior work experience to be eligible. Bottom line, not all cost segregation providers are created equal. So be sure to take the decision seriously from the beginning to protect yourself for years to come. Please contact Bedford's Business Development Director, Frank Judici, to learn more. Who's your prime candidate for this? That's, say, already operating, or somebody that's just getting into the business, or where does that fall? Like, who's your prime customer that or partner, I should say, with Park Place?
You mean partner currently, or what we're looking to partner up with?
Just like the operator that's looking to potentially use
Oh, I see.
crowdfunding.
Oh, so I see. Yeah,
Who is that? What kind
sure.
of deals are they doing or have done, or what do you all look for in that partner?
So far, the syndications, the asset under man. I mean, I'll get a little bit of this is off the top of my head based on the syndication we've been working with. I mean, their asset under management are about 50 to 100 million right now. So they're either smaller, but we have few that are about 200 to 300 million. So we have those that we're dealing with. They're not like 900 to $900 million. Those are the larger ones that and those really are not our client. I mean, they're not our target clients really. We're trying to grow with the syndications that we believe they are on the growth curve also, because the larger syndication, if they want to go into the crowdfunding, they're gonna go with this larger crowdfunding because for them dishing out 50,000-60,000 is not that much based on their their asset under what their goals are.
Sure. And is that person going to typically need that, say, $3 to $5 million raise per deal?
Oh, you're talking something like, yes, sure, of course. Yes, that's right. That's like 5 million. There are a couple that are trying to raise 10 to 15 million. Yeah, those are usually that's what the raise is usually. Yeah, you're right.
How does that work if they need 10 million? Can they only bring 5 million from the crowdfunding platform?
Well, I mean, for Park Place, we really don't set a limitation. We because they get connected to the investors directly. We are not a mitigator between the two. So we're not really playing that part. So when an investor is interested, for example, in Syndicate A's deal, they make that connection. And that's why it's a marketplace. We're not really managing the finances. We're not managing the deal flow. So that it's a connection. So that's when I say we're trying to democratize things. We're really doing that. We're not really, we want to make sure everybody succeeds. And with that, I think when the tide rises, we rise with it.
Nice. No, and how is that tracked through the process? You all have this investor base. You're making that connection to that operator. How is it tracked then, whether an investor actually invests in that deal or not?
There's a couple of ways. Our second phase of our platform would be investment management software that we're in negotiation to do that, and that would actually allow tracking. However, they may choose not to use that. So I mean, again, we're trying to. We will have a built-in investment management software. We have CRM, deal flow, tracking. However, having said that, right now the way they would track it is really based on feedback and also based on reviews. So it's like we have a Yelp review. So obviously, if a deal goes bad or something is not the investor is not happy, they either reach us or they review the investor, and that's public for everybody to see.
And so ultimately you're making the connection, right? The referral type. Yeah. And so what kind of vetting would you all do of that operator or the deal before you would make that connection?
Well, we actually would track the record. So we would have a one-on-one interview with them, kind of 30-minute meeting with them to see what they're all about, what their goals are, what their previous experience has been. Then we would do our own search, kind of go over and look at their previous deals and vet their online presence and also the previous deal history.
Nice. Okay. And so are there any, I know you mentioned like how new can this operator be, or, can it be their first deal, or is there a certain level? I know you mentioned the different numbers there that, maybe assets under management or something.
Sure. Absolutely. I mean, it could be the first deal. So the other segment of the market that we believe would perhaps, again, we're not targeting them, but that's certainly in our scope right now, is for those, a lot of syndicates actually, syndicators start as brokers or real estate professionals. And a lot of them, and some of them want to get into becoming syndicators. However, they don't really have the experience. So we do facilitate that type of relationship also. If it's their first syndicated deal, but that requires a lot more hand-holding. So we would require our the legal and the regulatory part of Park Place to really work with them to put their first kind of deal together insofar as meeting all the regulations, exemptions, and things like that. But as far as typically, our typical syndication would not be their first deal on the
Sure.
because if it is, then it meets kind of the criteria I mentioned, that it's a little bit more hand holding for them to be sure to succeed, because they're ultimately their success means our success. So we want to make sure that is
Right.
really in line, their interest with our interest.
How are you growing your investor base now? How are you all meeting investors and reaching out?
Sure. So we the core of the company is 6 partners that we have through the passing of time and just our experience. We've grown to have just our own listing, our own relationship, about 1,000 accredited investors we know ourselves. Above and beyond that, we are growing it through both certain campaigns we're doing, both on social media, both on internet, and also both on certain different types of advertising to get more accredited investors on board. However, we really know that when we reach a threshold of about 200 to 300 accredited investors, it really takes off by itself. It becomes very organic, and we haven't
Just by referrals.
So we have a complete, we definitely have a referral program, both within the platform itself and both through different mediums. Yes, and
Nice.
that's incentivized in certain levels.
How do you incentivize referrals to investors?
Well, I mean, those are things that there's certain kind of proprietary algorithms that we have to do, and we have to keep in mind that we have to keep our cost per acquisition of clients low, because that's something that is definitely a metric that's measured by VC firms and other firms down the road. So we don't want to just say, oh, we'll give you X amount of shares or
Right.
cash or whatever. That doesn't really work well for our model. So, but there's certain things we do that we're implementing.
What's a way you've recently improved your business that we could apply to ours?
I'm sorry, what is, I didn't hear the last thing you
What's
said.
a way that you've recently improved your business that we could apply to our business?
Oh, I gotcha. Well, I think one of the best ways, honestly, has been really having a more of an active LinkedIn presence. I don't want to promote LinkedIn and give it a thing, but I do like LinkedIn a lot. I've been able to connect organically with so many real estate investors and professionals through LinkedIn by itself that my recommendation for anybody that's trying to, grow their network, to really have a presence on LinkedIn. I don't know whether everybody knows that. I'm sure a lot of people do, but I think the more active you are on LinkedIn, it's definitely the social media platform for professionals and investors.
What's the number one thing that's contributed to your success?
I think my relationships with the people I know. That's, a business is nothing without a relationships. You could, if you don't have that, then, you could have the greatest platform online presence, but if you don't know how to nurture relationships, then you're not going to really make it, and especially in real estate business, and any type of sales.
Tell us how you like to give back.
Well, we are planning to donate 5% of our, actually this is very important because this was part of our initial, when we got to get 5% of our gross, actually, to our to a couple of things. One is a charity of our choice, and number 2 is our organization, which was a college organization. It's that we have, is dear to us, and we're going to give a certain percentage back to that.
Nice. Well, Kam, thank you so much for your time today. I appreciate you just elaborating on what you do in this business of Park Place and how that can help syndicators. And I hope many will reach out to you to see if they're a good fit, to partner with you. On that, tell them how they can get in touch with you and learn more about you.
Well, you could. I'm always on LinkedIn, so you could come at my name, Kam Zainabadi. Our LinkedIn is Park Place Investment. You could also go on our website, parkplaceinvestment.co, and the marketplace is parkplaceinvestment.com. So those are the two different websites. And our email is info@parkplaceinvestment.com.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.